Hello and welcome back. Today we're unpacking a critical issue that's not just a concern for China, but for the entire global economy. China's economic slowdown from 2023 to 2025. We'll explore the drivers of this slowdown, including a significant real estate crisis, alarming unemployment rates, and shifting international dynamics. With this analysis, we aim to shed light on the complex interconnections between China and the rest of the world. So, let's dive in. Our first topic is the ongoing real estate crisis, a looming storm that's significant for China's economy. Real estate has historically accounted for around 25% of China's GDP, a staggering figure that underscores its importance. Enter major players like Evergrande and Country Garden, both of which have faced monumental challenges. Evergrande alone is in over $300 billion of debt, with many of its projects lying unfinished, leaving thousands of homebuyers in limbo. This resembles the U.S. housing crisis in 2008, where excessive debt and speculation culminated in a broader economic collapse. Unfinished projects not only disrupt local economies, but also raise questions about consumer confidence and the political stability of the Communist Party. The consequences echo throughout the supply chains, as millions of workers tied to construction projects face job insecurity. As these developers falter, the immediate impact is clear: a deterioration of trust in the property market, leading to fewer investments and stalled economic growth. Next, let's discuss another grim statistic. Youth unemployment has surged past 20%, and the Chinese government's decision to suppress this data is telling. High unemployment, particularly among the youth, can lead to social unrest and disillusionment, drawing parallels to the Arab Spring, where economic despair fueled political upheaval. When young people see fewer opportunities, their confidence in the future wanes. In a country where education levels are high and expectations are rising, unemployment in this demographic is particularly controversial. Various analyses suggest that this issue may not be temporary. Instead, it may be an indicator of deeper structural problems in the economy. Like in other nations historically plagued by high youth unemployment, such as Spain during its economic crisis, the long-term implications could affect everything from consumer spending to mental health, leading to a lost generation. As we turn our gaze outward, we see significant foreign capital outflows. Multinational companies are increasingly relocating their production bases to countries like India, Vietnam, and Mexico. This trend began around the time of the US-China trade tensions, but it has only accelerated post-COVID, as companies seek more stable and cost-effective environments. For instance, tech giants have started investing heavily in India's burgeoning startup ecosystem, adjusting their strategies to diminish reliance on China. This shift echoes the phenomenon of decoupling, a term used to describe the separation of Western economies from China. Firms now seem to view investment in China as riskier, reminiscent of how many fled the volatility of markets in regions like Latin America in the 1980s. For China, this represents not just an economic loss, but also geopolitical implications as its influence wanes. Despite a careful reopening after COVID-19 lockdowns, domestic consumption in China remains weak. Household savings have surged, with many families opting to save rather than spend, driven by uncertainty about the future. When we look at consumer behaviors in economies that have faced downturns, like Japan in the 1990s, one often sees a similar phenomenon of precautionary savings. Data from recent years shows that consumer confidence hasn't rebounded as hoped. This reluctance to spend poses risks of a prolonged economic malaise. Unlike the rapid recovery seen in the U.S. post-2008 financial crisis, China's consumers are cautious, which could limit the effectiveness of government stimulus packages designed to boost spending. As China struggles with these weak consumption patterns, we may witness a tremendous imbalance between supply and demand, which could further exacerbate its economic woes. Now let's talk about the yuan and its enduring pressure in the global markets. As concerns surrounding the Chinese economy grow, so does the instability of the yuan. The government has resorted to using its foreign currency reserves in a bid to stabilize the currency, echoing strategies employed by other nations facing similar challenges. This strategy, while effective in the short term, raises significant questions about sustainability. When reserves deplete, the risk of currency devaluation increases, which can lead to inflation and further consumer unrest. The last few years have shown how quickly currency crises can escalate, taking us back to the 1997 Asian financial crisis. China's current predicament may ignite debates about its long-term economic policies, leading to debates on whether it's time for the country to seek a more market-oriented currency approach. Now, let's examine a major factor that could affect China in the long run: demographic decline. Projections indicate China's population may be diminishing, with a shrinking workforce having profound implications for future economic growth. Historically, declining birth rates have led to labor shortages and increased social welfare burdens, challenges experienced by countries like Japan. With fewer young people entering the workforce, the economic engine risks stalling. This demographic shift could turn China's current challenges into a long-term structural deficit, affecting everything from innovation to consumer spending. In the coming years, China may find itself wrestling with not just its present issues, but a future characterized by an improper balance of age and workforce contributions. Despite these formidable challenges, China still maintains various tools of economic control. The state-owned banks and control over resources, coupled with vast foreign reserves, provide the government with mechanisms to intervene in the economy. This centralized economic control can initially cushion the blows dealt by systemic shocks. However, as history shows, reliance on state intervention can stifle innovation and growth in the long term. While the economy may be shielded from immediate collapse, the fundamental issues like weak consumption and demographic decline remain unresolved. China finds itself at a crossroads similar to that of the Soviet Union, which faced stagnation despite wielding significant state control over its economy. The true question remains, will these tools be sufficient to navigate the complex economic landscape ahead? Finally, what are the global implications of China's economic slowdown? Can China still challenge the US as the world's leading economy? When we consider that China represents a significant driver of global growth, a prolonged slowdown could ripple through markets in Europe and emerging economies. Countries heavily reliant on exports to China may experience reduced demand for their products. For example, economies in Latin America and Africa poised to export raw materials or agricultural products could suffer if China's demand diminishes, potentially causing a broader economic slowdown. Meanwhile, the US is likely to view this slowdown as an opportunity to strengthen its economic position, leading to ambitious commercial strategies aimed at curtailing reliance on Chinese supply chains. In Europe, there may be strategic shifts to diversify energy and trade partnerships in response to China's economic unpredictability, raising concerns about how the global economic landscape will evolve. In conclusion, China's economic slowdown from 2023 to 2025 presents a tapestry of challenges, from the real estate crisis to youth unemployment and demographic decline. The question remains, is this a short-term correction or a long-term structural decline? While state-driven interventions may buffer immediate impacts, they do not resolve the underlying challenges the economy faces. As we ponder this complex situation, it's crucial to recognize the interconnectedness of the global economy. What happens in China does not stay contained. Its repercussions ripple across continents. Thank you for joining us on this insightful exploration of China's economic landscape. What do you think? Is this merely a hiccup in China's growth narrative, or are we witnessing the dawn of a prolonged economic decline? Let us know your thoughts in the comments below. Don't forget to like and subscribe for more in-depth analyses on global issues. Until next time, stay informed.